I'm Jubak, and welcome to my Trend of the Week video for this week. This week's Trend of the Week is low VIX in a risky market. This is really a puzzle. The VIX is supposed to be a measure of risk. In fact, it's called the fear index. It's supposed to go up when investors feel they need to buy more hedges on their portfolios or hedges against the market as a whole. It's based on tracking the prices paid for options on the S&P 500 index. So as fear goes up, people pay more and the VIX goes up. That's not happening now. So you see that on March 31st, the VIX was at all of 20.70. That's a little elevated. The long-term average for the VIX is somewhere around 17 or 18, but look where we've been. The highs on this is now, we're talking about 36 back in early March, not that long ago. We're talking about another high here, about 31 at the beginning really at the end of January of 2022. So why, given the fact that we've got a war in Ukraine, we've got global oil sanctions which are throwing the market into chaos, we've got defaults potentially on Russian banks as well as Russian companies, we've got an impending rate increases from the Fed, we've got the possibility of recession. Why do we have a VIX down here? The VIX is actually a very short-term measure. It looks at near-term S&P options, the prices, the inferred volatility that you can calculate from the prices of those over the next month to month and a half to 2 months at the outside. So what you're really getting is a sense of this is what the market feels about risk at the moment. And what that's telling you is that the market is not yet priced in a recession because, hey, recession is way out there. Second half of 2022, maybe 2023. The market isn't really sweating in that 1 to 2 month time period interest rate hikes. That the market says, hey, when the Fed meets in May and in June, they're going to raise 50 basis points on each of those occasions. That's a big event. But hey, that's May and June. Why would the VIX get excited about that now? I think what you're seeing is a real lag between the amount of fear that's out there and the amount of fear right here. And what that does is it should suggest to you that, hey, maybe somewhere along here you might want to buy a call on the VIX because it's going to go up when we get out there where all the fear is. But also at the moment that you really need to be making your bets because when the market starts to see that fear, feel that fear, stock prices are going to go in a very different direction than they have for the first few weeks of the spring. This is Jim Jubak. Thanks for watching my YouTube video. If you liked it, give us a like. Subscribe to my YouTube channel, which will give you indication of when I'm doing all of my videos. We're doing about 3 a week. If you want more of my stuff, you can subscribe to my free site, jubakpicks.com, and that gives you 3 portfolios. Or you can subscribe to my paid site, jubakam.com, which gives you 6 portfolios, including a volatility portfolio and some options actions so that we would be able to follow the VIX together and maybe make some money out of that volatility switch. Okay, thanks for watching.